We saw that there are three important methods of valuing goodwill, of which we have already discussed the average profit method of valuing goodwill. Now let us discuss the calculation of goodwill by the super profits method. In this method, the goodwill is calculated on the basis of the surplus profits earned by a firm, which is in excess of the normal profits earned by other similar firms. A business may have certain advantages that enables it to earn super profits rather than just settling at the average profits which other similar businesses earn. When the business is in a position to earn such additional profits, then it is more practical that the buyer of a stake or a new partner has actual benefit from such super profit earning capacity of the business. Hence, it is more practical to value the goodwill on the basis of super profits than on the basis of average profits. In order to calculate goodwill by the super profits method, first we need to calculate the normal profit and then we calculate the super profit, and finally we will discuss the calculation of goodwill. The formula for goodwill, as we can see here, is super profits multiplied by the number of years of purchase. We already know the meaning of the term number of years of purchase, which we have seen in detail while we were discussing the calculation of goodwill by the average profits method. Now let us see how to calculate the super profits. Basically, super profits are profits earned by a firm which are more than what similar firms operating in similar circumstances are earning. If a firm is earning super profits compared to its competitors, then it means that the firm enjoys some repute or a competitive advantage, which in numerical terms is the goodwill of the firm. Super profit, as the name suggests, is the profit in excess of normal profit. So, the formula for super profit is average maintainable profit minus the normal profit. We know the average maintainable profit of the firm by maintaining a profit and loss account. So, now let us see how to calculate the normal profit which the firm is generally expected to maintain in its business. The normal profit is nothing but the normal rate of return expected in the business in which the firm is operating. So, it's calculated as the capital employed in the firm multiplied by the normal rate of return and divided by 100, since the normal rate of return is in percentage terms. So, let us see the steps how to calculate goodwill by the super profits method. Step 1 is calculate the average profit. Step 2 is to calculate what is the normal profit earned by the business by taking into consideration the capital employed and the normal rate of return of such business. Then step 3 is to calculate the super profits by deducting the normal profit from the average maintainable profit earned by the firm. And finally, the goodwill is calculated by multiplying the super profits as calculated in step 3 by the agreed number of years of purchase. Let's take an example here. Mr. A has invested 1 lakh in his business where the normal rate of return is 10%. His past 3 years profits are 15,000, 20,000 and 25,000, and he wants to calculate the goodwill of his business by taking 2 years of purchase. So now let's calculate it. Firstly, the normal rate of return is 10% and the capital employed is 1 lakh. So the normal profit is 1 lakh into 10 divided by 100. That is 10,000. This is the normal profit. This means that the firms undergoing the same or similar businesses that Mr. A is also operating in make a normal profit of rupees 10,000 for every lakh that they invest. Next, we calculate the average profit of the business, which is 15,000 plus 20,000 plus 25,000 divided by 3. So the net is, this is 60,000 divided by 3, which is 20,000. Now we see that Mr. A has an average maintainable profit of rupees 20,000, whereas the normal profit that he is expected to earn is 10,000 rupees. So the super profit is 20,000 minus 10,000, that is rupees 10,000. Now that we know the super profit, the goodwill is calculated by multiplying the super profit by the number of years of purchase. So we multiply 10,000 by 2 and the goodwill value we arrive at is 20,000. So with this, we have seen another method of calculation of goodwill, that is by the super profit method.